Hey everyone, welcome to a Simpler Options Foundation, debit and credit spreads. Can you hear me and see my screens? Thank you very much for the confirmation. Excellent. Well, my name is Danielle, and I'm the VP of Options here at Simpler Trading. I am primarily a directional trader. I also buy stocks and build up long-term equity accounts as well. But primarily I trade options in a low risk, high reward type of manner. I'm also a regular Fox Business expert commentator and guest in addition to CNBC. You can find my chapter in John Carter's third edition of Mastering the Trade. I'm also working on my own book right now that's coming out next year. But overall, what I am is I'm an options trader, and I used to be a teacher as well. So here I am teaching you today. So today what we're going to be talking about is going to be calls, puts, and then spreads. So let's just review quickly, why you would select a call or a put. When you're trading options, one of the reasons why you would select a call or put would be because this is the strategy that would give you the highest potential for profit in the options market. The reason why it gives you the highest potential for profit is because you're not capping your gains in any way. When you trade a spread, you are going to be capping your gains, but when you cap your gains, you're also defining your risk. So, on one hand, a call or a put can be great because if the market crashes or if, a stock falls 30% overnight, that's how you can kill it. But how often does that really happen? Most of the time, having a trade on in which it's a little bit cheaper and it has more of a defined risk strategy is going to be more beneficial to you, except for in this kind of scenario. The negative of that, of course, because you cannot have the positives without the negatives, is that this is usually the highest risk option strategy with the potential for quick losses, just because they do move really quicker than you would get with a spread, and because any debit that you pay for a long call or long put can disappear. So there's a couple good things about this strategy. It can be used for account growth when it's done correctly. The bad thing about it is that if you don't understand how they work, you're going to lose money because you need to understand the different facets of how they're priced and why they work. Usually people get into just doing calls or puts because it's the next step after learning how to trade stock, and it's the easiest thing to learn in the options market because you're primarily focusing on, do you want to go long or do you want to go short? Yes, you do have to select the strike, expiration, and delta, but this is why a lot of people will focus on just the calls and puts. But the problem is that you have to know and be educated on how to select the right strike, the expiration series, and delta. The good thing about this, which is also the bad thing about it, is that you're only going to make money on this trade if the underlying trade's outside of its regular expected move. Now, in a market like this, it's not really a problem necessarily because the market is having big moves all the time. So, it's not unusual for a call or a put to work well. However, in a market where, it's really choppy, it's not really going anywhere, that is the kind of market where you're going to lose money on a call or a put because the market's not moving. To make money on a call or a put, you have to be able to pick an underlying security that's going to move more than what it's expected to move. So, of course, the positive is also the negative, which is that you're only going to make money on it if the underlying moves exponentially. So when you're talking about, buying calls or puts, that's generally the segue from stock to options trading. The good thing about it is that buying a long call or put will give you leverage you're not going to have with stock, because of the way that the options contract functions. So with the options contract, typically we usually buy around a delta 70. This example is for an in the money call option. Typically when you're buying an in the money call option, especially for a swing trade, it's going to be for, 15 to 90 days till expiration. And when you buy a call option with the delta 70 strike, basically what you're doing is you're paying a certain amount of premium, and you're also paying for a certain amount of intrinsic value. The intrinsic value is what the option's actually worth, and then the premium is the juicy part on top, that also is going to decay over time if you're wrong. So basically what you need to have happen for you to make money is the option pricing has to move from, where you bought it. So if you bought it right here, it needs to go higher than the amount that you spent before you can get to break even, and then before you can reach your profit potential. Because, you're paying a debit to own that options contract, and that debit is either going to go up in value more so than what you paid into your profit zone, or if you're wrong, the premium is just going to decay over time. And if the stock price actually goes down, then the intrinsic value portion of the option contract is going to go down too, and then that's how you lose money on the options contract. So when you're buying a directional option, the factors are going to be the same as what you're looking for with a spread, but you're just only focusing on one leg. So when you go to your options chain, you're going to want to look at a couple different factors up here. Generally, we're always going to look at volume and open interest. Is there enough liquidity? This is something that's especially important with spreads, because if you're looking at your volume and open interest and there's no contracts being traded, you really can't trade a spread. You might be able to get away with a call or a put, but if there's no contracts being traded, there's not enough liquidity, and you really can't trade that strike in the options market. You're also going to need to select your days till expiration. You need to give yourself enough time to be right. And then you also are going to have to select your strikes. So when you're talking about going from a call to a debit spread, really all you're doing is you're just adding another strike. And the reason why you would do this is because it's going to give you a situation where your trade setup is going to be more conservative than just buying calls or just buying puts by itself. The reason why it's more conservative is because it's going to cost you less money. So, for example, if before you were going to buy one call at the 100 strike, and then you wanted to make a debit spread, all you would do is you would just add another strike, a short strike up above, depending on where your target would be. So, if the stock price is at $100 and you want to buy a $100 strike, and you say, well, my target is at 105. I don't think that the stock price is going to go higher than that. Let me go ahead and add another strike up here at 105. That's going to be a short strike instead of a long strike. And you now have a debit spread. Okay. So what you have done for yourself is you have taken the price of the long call. Let's say this long call was $5. Just make it up. And let's say the short one was $2.50. Okay. You paid $5 for this one, but you sold this one for $2.50. So now instead of paying $5, your net debit is only $2.50. So the reason why it's more conservative is because you can cut your price in half. So depending on where you put your strikes. It's more conservative, but it does also cap your gains. So what that means is that if the stock just has some crazy announcement overnight and it ends up at $120 a share, you're never going to make more than the width of the spread from here to here. If you had a just a call, you would capitalize on the whole thing. So, setting up a proper debit spread enables you to pay less than call or put alone to be directionally long. It also hurts a lot less than directional options in case your stock trades sideways instead of exploding higher. This is one of the main factors that I think is really important because, I mean, hey, let's face it, I wish we could all, put on a trade and it would immediately go to our target and it would be amazing and perfect, but that's not what happens. A lot of the time, you get into a trade and the stock's trading at 100 and maybe it stays here for a week or two before it goes anywhere. So when that happens with a long call, the long call is decaying over time. And, let's say you spent $5, goes down to $4.75, then it goes down to $4.50, then it goes down to $4. Then finally you get your move where it can go up in value, but it's losing money over time. With the spread, it's not that way because you have a long call here, but you also have a short call here. So if you're stuck in this zone, this short call is decaying, which is a great thing because you sold it. So with a spread, you can actually maintain at least your break-even price, if not make money, when the market's not really go in your direction immediately. You can still make money on the strategy if the underlying trades slowly higher without an explosive move. So that's the other reason why I really like it, because the market really only has explosive moves like 20 to 30% of the time. So, when you're in these kind of slow, meandering, just dying moves, the spread is generally going to be a better option for those reasons. So if you're looking at, a span of 100 trades and you say, okay, well, would it have worked better just buying calls or just buying puts or a spread? The majority of the time, it's going to work better with a spread, except for those few times where, the market just drops like a rock or something like that. So that's why I really like to focus on spreads a lot. Now, the debit spread, it's going to look about the same as the call. The only difference here is that when you sell another call option, which, you can do it at a variety of different places. You can use a Delta 20, you can use a Delta 30, you can try to use a Delta 40, but really where you want to sell the other option is going to be where your target zone is, because you don't really want the price of the stock to go too much through here, and you want to be able to get a credit for the option that you're selling. And if you're, selling it all the way up here, there's not going to be a credit because there's not going to be really any value in those options. So you want to try to just identify a range in which you think the stock is going to, trade up into that zone. So here's an example of setting up one in Google. This was a screenshot pre-split, but basically when you are looking at a long call, you'd set it up so it says vertical, buy 1, sell 1. So it's going to be a call debit spread. So this one would be 12.25, this one would be 13.20, and then the trade is a debit overall because you're paying a debit for this one and you're getting a credit for this one, and this gives you the overall price after both of those contracts are executed. Now, when you're talking about going from a debit spread to a credit spread, a credit spread is a strategy that I really enjoy, especially in a choppy market. it can be good in a volatile market as well, especially like right now in the market, we have had the indexes careen down to lows on the year. Anytime you find the stock market at a place where it is in a zone of support, that is a time where I really like to identify locations where I can do put credit spreads. Because, for example, what you'll see is you'll see the market going lower, 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 and then at some point it'll start to turn around, right? So on these lows, these are moments in time where you can come in and say, oh, well, what kind of trade could I do in this environment? Well, you can sell put credit spreads, because what happens is when the market is falling, the puts get really juiced up. What that means is that the puts are more expensive than normal. When the VIX spikes, when people are panicking, that is when that is the time frame where those puts are going to have even more value. So when you're looking for a time to use that kind of strategy, generally in this kind of environment, it's a good one, but you do have to identify a key zone of support to sell those put credit spreads against. So the idea is, in a bear market, when you're looking at price to fall and then bounce, you can sell spreads at the bounce points on the way down, or in the bull market where it's continually trading higher, you can also sell spreads at the support zones before it goes higher. The place where you do not want to sell spreads is if you don't have support. So for example, say the market's just falling like this. You really don't want to be stepping in and trying to sell puts here, selling puts here, selling puts here. What you need to see is you need to see an actual bounce and an actual hold. That's supposed to be a hold of support to put a spread at a support zone when the bounce starts coming through. So a lot of the time what you'll see, for example, in the options room, is you will see any of the traders, John, Cody, Sam, whoever, when the market is even just on an intraday basis for the XPX, let's say that, the market opens up and then it falls down and then it stops falling and it levels out and it starts to trade higher. The traders will come in and they'll say, okay, well, I'm going to sell a spread in the SPX right here because I think that the market's going to, bounce the rest of the day. So it could even just be a day trade instead of, looking for a major swing trade key support zone. That could definitely, work as well. And it's a pretty common strategy that traders are using in the trading room right now. So let's just talk about the positives and negatives of using this strategy. I mean, for me personally, I think it's the most conservative way to trade, because a lot of the time, especially, when you're looking at, kind of like a volatile market, when you sell a spread, you can never lose more than the width of the spread. So for example, say you're doing, let's say we're doing stock, I guess we can stick with put credit spreads instead of call credit spreads, but we can do call credit spreads as well. So for example, let's say that the price of the stock is trading at $100, and then let's say that it falls down to $95, and then let's say it starts to bounce, okay? And you say, all right, I really don't think that this stock is going to fall below $95, So what I actually want to do is I want to sell a put credit spread. I don't care if it goes to 100. I don't care if it goes to 120. I just think it's going to be above $95. The reason why it's the most conservative way is because with a call or debit spread, you actually need the stock price to go up into your target zone. With a put credit spread, you don't need it to go up into your target zone. You just need it to stay above the area where you sold it. So for example, if you are going to sell a put credit spread, you could sell one of the 95 strike in that fall to support. Then you would have to buy another one for protection. So the difference between trading naked and not trading naked and having a spread is adding the protective leg. If you just sell the 95 put and you're completely wrong and the stock falls to $70, you can blow out your entire account depending on the sizing that you're doing because you have no protection by selling that 95 strike. And someone could come to you and say, hey, I want to exercise that short put you bought. And then that's where you get into trouble. But with a spread, you only have the amount of risk that you put on. So if you sold the 95 and you bought the 90, when you're doing this, that happens on margin, but it gives you the what happens is it'll tell you exactly how much you have at risk. Okay, so these kind of trades work on margin. You have to have margin in your account, and it'll tell you how much margin you need for a trade like that. It's completely dependent on size and on the ticker you're trading and stuff like that. So it might say, okay, you need $500 of margin to do this trade. But it depends entirely, how much you can make or lose depends entirely on the pricing. Okay, so for example, this is a $5 wide spread. Okay, the most you could ever have to buy back the spread at, which would be a loss, would be the width of the spread. $5. Okay, but the most important part of this is the credit that you get. Okay, so it's not just, oh, it takes $500 of margin to do the trade. It matters how much credit you get, because some people will try to sell these spreads out of the money, and let's say that Joe comes in here and sells the spread and he only gets $1 credit. So Joe gets $1 credit. Then Susie comes in here and says, hey, I don't want $1 credit for selling this spread. I want $2. And then Valerie comes in and says, you know what? Actually, I want a credit of $2.50. Now, when I say they want that, obviously they can't just say, open sesame market, give me a, $2.50 credit. The credit is going to depend on where the price of the stock was when you entered the trade. So if Joe is putting on this trade and he's only getting $1 credit, it's probably because the market's trading around $100 and this is out of the money. If Susie's doing the exact same trade and she's getting $2, it's probably because the stock price is trading like 96, maybe 97. But Valerie decided to do it right when the stock price was right at 95. Okay? The reason why she gets the biggest credit is because she did it when the stock price was at the money, and that's when the puts were the juiciest. So she gets the most credit. All three of these people are using the same amount of margin. The margin required to carry the trade is going to be the same. But the difference is how much they can lose. Because the most you would have to buy this trade back for if you're completely wrong, like let's say the stock price opens up at $70 the next day, it's a defined risk trade. Valerie got a $2.50 credit for getting in, and now her trade's at a max loss. she has to close it for $5. Okay. When you sell a spread and it loses money, you have to buy it back for the max spread, which is $5. So she only lost $2.50 because she took in $2.50 and then she had to buy it back for $5. So she loses $2.50. Now Susie, she got $2 to get in. She has to buy it back for $5 as well. So she lost $3 on the trade. Now Joe's the one who comes out the worst of it all because he only got $1 credit coming in and he had to buy it back for $5 as well. So he actually loses $4. The amount of margin that they used to carry the trade was the same, but because they got various credits on the same exact trade, their risk reward is different. So you're losing, it's not that you're necessarily losing the margin per se, it's that you're using the margin on your account. Like let's say you have, I don't know, $20,000 of margin that you're allowed to use to trade. It's not that you're losing the margin necessarily, it's that you're using that margin to trade. And then when you lose the money, you lose that cash value in your account. If you're using it, if you're only trading on margin, then yeah, it comes out of the margin value. But most people have cash in addition to their margin. You might just have only margin you're trading on with stock in your account, but most people usually have cash that they're trading in addition to the margin. So for your specific account, it's really important if you're trying to understand, am I going to lose margin or am I going to lose cash or what is this going to look like? You really have to talk to your broker and you have to ask about the specifics of your account because it can vary, if that makes sense. So, anyways, some of the best parts about the put credit spreads is that you really don't need, if you think the stock is going directly to 120, it doesn't matter if you're right necessarily as long as it stays above 95. You can make money on the trade if the stock trades sideways, higher, or explodes higher. Just because the main goal is that you would want the stock price to stay up above your short strike. Okay. Holding through pullbacks is also usually a lot easier because the trades, they just don't move as much in value as like a long call or put would. So it's usually easier on your brain mentally because you don't have to look at these massive P&L swings. Usually the spreads are going to be a little bit more conservative. You can also combine the strategy with long calls or debit spreads to create a more complex position. So for example, the stock falls down, starts to trade higher. You can sell the spread here at 95, but then you can also buy a long call to add to your trade to give yourself a little bit more juice. So here's an example of what the graph would look like. Basically, you are just, when the market would fall, you'd be selling a put option right here. And then what you're doing is you're getting a credit for that. So you're getting a credit for that. So you sold it at the 95 strike. You got a $2.50 credit. Well, you're going to start losing money if the stock price drops down below the price of the credit. So let's say you sold it when the stock price was at 95. That means you have 95 minus $2.50, and that's the point where you would start losing money. But as long as it stays up above here, you are good to go. So, it's usually a great strategy to utilize when you want to find risk. You believe the equity will stay above a specific price. You want to sell premium instead of buying it. You want a strategy to even out the positive deltas you've purchased. And you want something that's relatively stress-free. The reason why it works is because options decay over time. And what you're trying to do when you're selling a spread is you want to take advantage of the fact that, especially within the last 30 days till expiration, that is when options decay the most. Okay? They decay the most, they decay the quickest. And so if you sell options during that time frame and you do it in the right direction, you could take advantage of an option that's going lower in value. When you're selling an option, you want it to go lower in value because you sold it to somebody at a high price, hopefully, and you want that value to disappear and go directly into your account. So the way that you make money is that you need the stock price to stay above the short strike by expiration. So it means the stock only has to trade sideways or higher versus straight up. You lose money when it falls through your short strike. So here's just 3 different examples. The market was falling. You sold a put credit spread down here. If it falls through your short strike, you're going to lose money. If the stock price, falls and then just chops, you can make money slowly. If the stock price falls and then goes higher, you make more money more quickly. So when you enter the credit spread, you're selling to open for credit. Your risk is defined by the width of the spread minus the credit you receive. And the idea is that you're selling premium outside where you think the market is going to move. So your goal is to try to capitalize on the fact that somebody else is purchasing these options and you think they will expire worthless, or they'll be worth less than when you sold them. So the whole purpose of this is to have the credit you sold slowly slip away, which will give you more profit. So here's just a couple of different examples. Basically, when I'm looking at an options chain, I usually want to look at the options that are right at the money because those are the ones that are going to have the most value. So typically, if they're right at the money, they're going to be, borderline between the blue section and the black section in Thinkorswim. But it should look like this in your platform. Different platforms will show it a little bit differently, but in Thinkorswim it says vertical. So you sell and then you buy. You want to make sure they're equal amounts. And then you're selling the higher price put and you're buying the lower price put for protection. And then it'll give you an overall credit based on, what that value is. So when you are selling a put credit spread, you can also, combine that with a strategy like a butterfly. So then that way, when the market falls, you sell your spread down here, and then you can also buy a bullish trade targeting a price over here if you want to, combine trades. Another great thing that I like about the put credit spreads is, you can do them with a small account. You can, make a put credit spread that's only $2.50 wide. You're getting $1.15 credit and you're risking, less than $300. I think it's a really good strategy for people that do have smaller accounts because you don't have to even think about getting into these crazy debits like you would with a call or a put. So here's just another example of a smaller one. This one's $5 wide for $2.40 credit. And the one that I had up here was $2.50 wide and it was only $1.15 credit. So you can make it wider or you can make it tighter based off of, how much risk you're willing to have on the trade. So with this one, this is just another example of, making a pretty small spread. This one was only $2 wide, but I was able to get a credit for 80 cents. And, you can also increase your risk by doing more contracts. So in this case, I did 4 contracts. This trade was risking less than $500 with a max profit of $320. And then it also shows you on here, what kind of credit you're getting. The buying power impact was only $486. So that was basically the margin that I was using. So, It uses up the margin in your account while you're in the trade. So, you can't have like 50 different spreads on because it would use up all your margin, right? So it's just telling you that it's holding that $486 of margin while you're in the trade. But the max loss is $480 and the max profit's $320. So it's just basically holding on to that. And then, if you lose money, for me, because I have cash in my account, it'll take it out of the cash portion. And obviously if you lose a lot of money, the margin you can use is lower because you don't have as much money in your account now. So to summarize, put credit spreads are useful to take advantage of time decay, to have a defined risk strategy, to sell premium versus buying it on trending charts, when directional charts pull back, or at key areas of support. So that is it for my presentation today on Options 101, talking about spreads. If you want to follow me or learn more, go ahead and follow me on Twitter. You can find me at Trader Danielle. That is just TRADER and then DANIELLE. So this is my real profile. There are a lot of fakers out there, so be careful. But you can follow me there, or you can follow me at 5startrader.com. This is going to be my free newsletter where you can go and sign up and get some more options education. I also have a free webinar that I just did about an earnings season breakdown if you want to check that one out on my newsletter. Other than that, I hope you have a fantastic rest of your day. Let me know if you have any questions, and I will see you next time.